Good evening, everyone, and welcome to the February 23rd edition of Office Hours. My name is Tisa Silver Kennedy. I'm the founder and director of the Maryland Center for Collegiate Financial Wellness, and I thank you so much for joining me this evening. If you have any questions, please do feel free to put them in the chat, or if you're joining on Facebook Live, please do drop the comment there, and I will check periodically to make sure that I'm answering all of your questions. So, without further ado, let's get started with this evening. First, I want to give you a quick agenda for the evening. We're going to talk just very briefly about the center, then specifically about office hours, and from there we'll go into questions from our community. And I really didn't have too many tonight, so I'm hoping that we'll have plenty of questions from members of our community to help me pass this time. All right, so about the Maryland Center for Collegiate Financial Wellness. We were founded in 2021 with an ambitious vision for all college and career school students in the state of Maryland. And that's that they are creditworthy, ready, resilient, empowered, successful, and thriving. If that sounds like a vision that is helpful to you, I encourage you to visit us online at mccfw.org and also follow us online via social media. We are at the MCCFW, and our mission is to help students and families build their financial life skills and empower them to thrive. We know that part of thriving comes down to student loans and how to repay those loans for people who had to go into debt to pursue their higher education goals. So that brings me to Office Hours. Office Hours is a free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate loans and prepare for financial success beyond repayment. I must give the disclaimer that Office Hours is for informational purposes only. There's a lot of information that I'm going to share with you this evening. Much of it is pulled from the Department of Education and their Office of Federal Student Aid. However, we're in a period where a lot of things are changing. There are a lot of one-time benefits, and many of the decisions that you are approaching are so very personal that I would not want you to take the information that you hear tonight as specific advice for what you should do. If you do have a specific question, I strongly encourage you to reach out. You can reach me at asktisa@gmail. That's ASKTISA@gmail.com. And we have a contact form on our website at mccfw.org/contact. You can leave a question there. And if you need one-on-one advising, we can provide that for free as well. Just fill out the contact form and a member of our team will get back to you. But the information that you hear tonight should not be construed as financial or legal advice, just reliable information that you can use along with an assessment of your personal situation to decide what's best for you. And now that I've got that out of the way, let's go to our first question. The first question this evening is, I paid off my student loans during the pandemic. I requested a refund and received it. What should I do now that the $10,000/$20,000 relief plan is up in the air? So this question has quite a few layers to it. So I'm going to walk through some background about where this comes from, and then some specific information for the borrower who submitted this question. So for the background, we have been in what's called the CARES Act forbearance since March 13th of 2020. And during that CARES Act forbearance, payments have been paused and interest is also not accruing. It was announced last year that the Biden-Harris administration would implement this broad cancellation plan that could provide relief of up to $20,000 in cancellation for most federal student loan borrowers, pending some eligibility requirements. So after that plan came out, there were a lot of people who had paid off their loans during the pandemic or had continued to make payments toward their loans during the pandemic. And many of them were wondering, well, can I get this relief too? Because if I had known there was going to be cancellation, I wouldn't have paid the loan off during the pandemic. So another announcement came out that said that borrowers who repaid direct and federally held student loans, that's federally held federal student loans, during the pandemic can request a refund of any payments they made during the CARES Act forbearance. And again, that forbearance went into effect March 13th of 2020. And the question many people have is, why bother? Well, if you had paid off your loan during the pandemic, you would not have access to the up to $20,000 worth of cancellation that is provided through the Biden-Harris Student Debt Relief Plan. So the idea was for a person who had paid off a loan or made payment toward the loan to contact their servicer, request a refund. Once the refund was delivered, and this is specifically for a person who paid off their debt during the pandemic, once they receive the refund, receiving that refund reopens the loan because they had paid off the debt. They're getting a refund of the payments they made on the debt. That means that the debt becomes active again. The idea was that the debt would become active again, and then the person would apply for and receive relief through the Biden-Harris Student Debt Relief Plan. And again, that plan was offering up to $20,000 worth of cancellation per borrower. So a lot of people requested refunds, and some people have received those refunds, but things changed. Of course, there were some lawsuits to block the Biden-Harris Student Debt Relief Plan from being implemented. And some of those lawsuits were initially unsuccessful, but now have been appealed all the way up to the Supreme Court. And the Supreme Court will have to decide if the relief plan is indeed legal and able to move forward. So the current situation with this particular borrower, they paid off direct loans during the pandemic. After the announcement of the Biden-Harris Student Debt Relief Plan, they requested a refund. They received that refund earlier this year. Receiving the refund means that the loan has been reopened. And now that the relief is up in the air, they're wondering, what can I do to make sure that I'm holding on to this relief? So to answer that question, as with most questions that you all have come to know now, if you've been to office hours before, your strategy depends. In this case, there is another factor that we have to bring into consideration, and that's the outcome of litigation. Oral arguments are set to begin at the Supreme Court next week. So if the plan is approved, this particular borrower will receive relief that cancels the debt up to $20,000 depending on their eligibility. However, if the plan is barred, that means that the borrower will be responsible to repay the loan. So there are other options for cancellation, but again, it depends on the loans and the person's financial circumstances. So I just want to walk through a couple of the options that I've been speaking about in our last few sessions. The first one is the IDR adjustment. The IDR adjustment is another one-time happening that is basically going to result in everyone who has direct loans or federally held federal student loans getting a payment count to let them know where they are relative to the goal, the requirement for cancellation through an income-driven repayment plan. So people who have been in repayment for 20 or 25 years, the IDR adjustment could really help them get closer to cancellation. And it's regardless of whether they work in public service or regardless of whether they work at all. This is about repayment under income-driven plans and the fact that they have a cancellation provision included that's supposed to be available to borrowers after they have repaid their loans for 20 or 25 years. Unfortunately, for this particular borrower, the IDR adjustment probably will not be of much help. These loans are less than 15 years old, and I don't think that the outstanding balance is something that they wouldn't be able to pay in another 5 or even 10 years. So the IDR adjustment probably won't give them much help. However, PSLF could be helpful for this borrower. The borrower works for a religious organization, and that religious organization, I'm not sure if it's set up officially as a 501c3 tax-exempt organization. However, religious organizations in some cases are able to receive the same treatment as 501c3 tax-exempt organizations. So this person works for a church or a place of worship. That organization could be treated as if it were a 501c3 tax-exempt organization. So the person would have to, one, find out if the organization is a 501c3 tax-exempt organization officially, or if there are some extra steps that they have to take to document the work of the organization and prove to the Department of Education that this employer should qualify. The other thing they have to do is look at their employment. And has their employment been as a W-2 employee, or has it been contract work? for which they would have received a 1099 during tax season. With public service loan forgiveness, the requirement is you have to be directly employed for a qualifying employer. So employment arrangements where the person is paid via contract and receives a 1099, that's not considered direct employment. That's contractual work. A person might be an independent contractor. Ultimately, their personal business is a for-profit business. So if they work directly for the nonprofit or tax-exempt organization, then they're considered as having employment that qualifies for public service loan forgiveness, with the requirement that they also work for an average of at least 30 hours per week. Or if they have more than one job and all of the jobs that they had were for qualifying employers, they could combine those hours to meet the 30-hour minimum threshold. So I think PSLF is definitely worth exploring for this borrower, given their employment and the fact that they have less than 15, but more than 10 years of repayment history and employment history. But since this person has already received a refund, of course, they're wondering, how are they going to hold on to this refund? So my suggestion would be not to spend it, to save that refund until we find out what happens with the Supreme Court case. If the Biden-Harris Student Debt Relief Plan is upheld and allowed to move forward, then this person can expect to receive cancellation. It could be up to $10,000 or $20,000, depending on their eligibility. On the other hand, if the plan does not go through, the person will need to repay the loan. They could decide to pay it back over time or use the money that they received via the refund to just pay the loan off once more. I know that this seems like a lot to go through, but when the option was announced that people could receive a refund, many of us were not expecting that the plan would be halted. Figured litigation was coming, but did not know that the plan would be halted. So we'll have to wait and see what happens with the Supreme Court, and that will determine whether this particular borrower needs to repay the debt or if they'll be able to have the debt canceled by way of the Biden-Harris Student Debt Relief Plan. I'm going to pause for just one moment and take a look to see if we have any comments or questions in the chat via social media. And I don't see any on Zoom, so I'm going to go ahead and move forward. All right, so just a refresher on the Biden-Harris Student Debt Relief Plan, because there are still some people who did not apply for the plan when the application was available online. If you visit studentaid.gov, you will see an announcement on the homepage that mentions that the plan has been blocked. And you can also go to the announcement, which gives you the full details of the plan, including the eligibility requirements. But if you're looking for something that's short and sweet, then this is it here. Eligibility really comes down to 3 questions. 5 if you're looking for the highest level of relief, which is up to $20,000 per borrower. So first question is, are your loans federally held? You can find that out by visiting studentaid.gov. When you log into studentaid.gov and you look at your servicers, if the servicer has Department of Ed in front of it, you know that the loans are federally held. If it's, I want to say default management collection systems, I might have had those words switched up a little bit, but if you see that, that means the loans are federally held. If you don't see any connection to the Department of Education or that default management group, then that means your loans are commercially held loans, and commercially held loans are currently not eligible for relief through this plan. If your loans have been included in this CARES Act forbearance that went into effect March 13th of 2020, then your loans are federally held, and that would mean that they could be eligible for relief through this plan. So if you answered yes to this question, you move on to question number 2, which is, were your original loans dispersed before June 30th of 2022? Basically, if the first time you took out a loan was after June 30th of 2022, then this particular relief plan would not benefit you at all. It's looking at existing borrowers, and those are borrowers who had their loans originally dispersed prior to June 30th of 2022. If you're wondering about the disbursement dates for your loans, you can go to studentaid.gov. And when you view the details, if you scroll down to a section called the loan breakdown, you can see the disbursement date for every federal student loan that you ever borrowed, regardless of when you borrowed the loan or what institution you were attending when you borrowed the loan. If you answer yes to that question, you can move forward to the third question, which is about your adjusted gross income. For the year 2020 or 2021, was your adjusted gross income under $125,000 for people who are single or married filing separately, or under $250,000 for people who are married and filing jointly or filing as head of household? To find this information, you would need to go to your personal income tax return, Form 1040, I believe it's line 11, and find your adjusted gross income. And it doesn't have to be for both years. It's supposed to be for either or 2020 or 2021. If you answer yes to all of those questions, then you should be eligible for up to $10,000 worth of relief. Now, for an additional $10,000, you need to answer yes to another two questions. The first one is your balance on loans borrowed for your own education greater than $10,000? This question is specifically for people who might have Parent Plus loans. If the only loans that you have are Parent Plus loans, then the maximum amount of relief you would be able to get through this plan is $10,000 worth of cancellation. However, if you have Parent Plus loans and student loans that you borrowed for your own education, you could be eligible for more than $10,000 if the loans that you took out for your own education exceed $10,000 in debt remaining from those loans. And the fifth and final question has to do with Pell Grants. Did you receive a Pell Grant? To verify the answer to this question, you want to go to studentaid.gov. And usually when you log into the dashboard, you'll see a blue circle for loans and a green circle for grants. If you see that green circle and you look at your grant history, you can see whether you received a Pell Grant. And for this question, the answer is just a simple yes or no. It doesn't matter how many Pell Grants you received. The dollar value of the Pell Grant does not matter. It's just, did you receive a Pell Grant? If you received one, you can answer yes to this question. If you answered yes to all 5 questions, then you should be eligible for the maximum amount of relief through this plan, which is up to $20,000. Now, because the plan is currently on hold, awaiting a decision from the Supreme Court, the application is not available. If the Supreme Court allows the plan to go forward, the application, the online application will be restored. And when it was originally released, it was set to remain available until December 31st of 2023. So hopefully we'll see a decision soon. If the decision allows the plan to move forward, there should still be an opportunity for people to apply who did not apply before the application was shut down. All right, so let's move on to the next question. This question has to do with public service loan forgiveness. This says, I submitted a PSLF application in November of 2022. I just received a letter with a qualifying payment count of 115. What are my next steps to get approved for PSLF? So this borrower is well on their way to PSLF with 115 out of the 120 qualifying payments necessary to secure forgiveness. And they want to know how they can stay on track to make sure that they're getting approved. So what I wanted to share with you is content from the letter that this particular borrower received. And as I just mentioned, PSLF requires 120 qualifying payments. So because this borrower has less than 120 qualifying payments, the letter that they received basically says they're not eligible yet. So they've been denied. If you receive a letter like this, please don't take the denial as something that's permanent. It's just that at the time that the count was conducted, you had not met the requirement of having 120 qualifying payments yet. So think of it more as delayed, not denied. So when you have this letter and you're on track to getting toward that 120, where within the letter can you look to determine where you stand relative to that 120 payments? So we have several columns here. The first three columns have to do with the loan details. Then we see PSLF eligible payments. A payment that is considered eligible is a period when a payment was made, or if the application is being evaluated under the waiver or the rules of the IDR adjustment. It just means the repayment status would make it eligible for PSLF if employment was confirmed to match that period. So the next column you see is PSLF qualifying payments. These are the payments that matter when you're making the count toward 120. Of the 177 payments that this borrower has, 115 of them have been deemed as qualifying for PSLF because the employment has been verified to match the eligible payments. With 115 total payments made, that means this borrower has 5 more payments to go. So they are approaching the finish line. The good thing is this borrower is still currently employed with a qualifying employer. So the first place I would recommend looking is the far right column, which is estimated eligibility date for PSLF. And pardon that edit there, the screenshot got cut off. But in that column, it's normal to see a date, which is a projection for when the servicer believes you will make your 120th payment. In this case, it says NA, which is definitely not helpful. So the next place I would recommend looking is a bit farther down in the qualifying payment count letter, and that's where you can see the list of your employers. And for each employer, you should be able to see the approved employment beginning date and the approved employment end date. So if you look at this borrower's qualifying employment, there are several ranges there, but if you look at the very last one, the most recent end date is November 15th of 2022. So if that's when the employment ended, then that would lead me to believe that the 115 qualifying payments is based on employment that ended in November. It is now February. So that would mean that December, January, February, March, April, those 5 months would bring the borrower to 120. So if that's the case, then this borrower, once they reach April, I would suggest sending in another PSLF application, maybe mid to late April. I've heard a couple of varying reports about sending it in too early in the month and not having the full month be recognized. So perhaps it's best to send, I'm not sure, but perhaps it's best to send it after mid-month. But what's absolutely necessary is sending in the PSLF application once you reach the 120th month. So if April 2023 is that month, then in April, you want to send in the PSLF application again so that the servicer can verify these past 5 months of employment, and then wait for the decision, which they say could take up to 120 days. So this brings me to a point where I think we should revisit the borrower experience, because it is definitely evolving. And along the way to the approval, there are several communications, and sometimes people are unsure what these communications mean. So I just wanted to share some experiences with applying for PSLF, with the note that these are based on self-reported statements from borrowers. So these are borrowers that I've worked with who are keeping me in the loop about what they're experiencing. I'm not speaking for the servicer in saying that this is exactly how the process works. And I'm not speaking even for the majority of borrowers. I'm just sharing what has been shared with me from the borrowers in my circle. The first point is that the process seems to be working more quickly for people who had to consolidate, maybe because they had FFELP loans or a mix of FFELP and direct loans, or even direct loans with different lengths of repayment history. Whatever the case was, they had to consolidate and then selected MOHELA as their servicer. These applications seem to be moving faster than people who did not consolidate but sent a PSLF application directly to MOHELA. So the second case would be a person who, let's say, had all direct loans, all from the same higher ed experience, and had no need to consolidate. Their loans were held with a different loan servicer. They sent the PSLF application to MOHELA, and receipt of that PSLF application should initiate the transfer of their loans from one servicer over to MOHELA. I've heard from several people that this process is taking a long time. Some people that filed their applications in October prior to the deadline of the limited waiver have said that they have not heard anything back yet about the receipt of those applications. The worst case scenario, I would suggest sending in another PSLF application. I've heard of some people sending them certified mail to make sure that they are received. But since most of the benefits of the waiver have been effectively extended until May 1st of 2023, if there is no record of the prior application, then submit another PSLF application and follow up with MOHELA to see if they receive that application in the coming weeks. Just make sure to get that application in by May 1st of 2023. A bit more about some of the communications. This is for people who have had their loans successfully transferred to MOHELA. I'm just sharing a few experiences, especially from people who consolidated and then applied for PSLF. The first experience is with the first qualifying payment count letter. This count is unusually low. And as a matter of fact, I just received an email from someone this morning who said, you know what, this doesn't make sense. I've only received credit for 3 months. You know, I've been working at the same place for 17 years, had the loans for more than 15 years. You know, this makes no sense. How can we appeal it? And that is a perfectly reasonable response. But that unusually low initial qualifying payment count is the way that the process seems to be working for everyone who has consolidated and applied for PSLF. It appears that the payment count temporarily resets to 0, and the first payment count only considers the history of the consolidation loan. So if you consolidated in October and you received a letter this month, the only months that would be examined would be October forward, and that's not a lot of history. But after this initial unusually low payment count, another count is conducted, and that qualifying payment count begins to or altogether reflects all of the history, the months of repayment prior to consolidation. For some people, I've seen them get that unusually low count, and then the very next count, they're over 120 or close to it. For other people, like recently I saw a case where somebody had like 5 qualifying payments to begin with, then it went to 22, and all of a sudden it shot up to above 120. And in that particular case, the person had worked for the same employer the whole time, had a very straightforward application, but for some reason, the count just didn't all happen at one time. So all of this to say, if you see that unusually low payment count, that is, I think it's safe to assume that that's an indication that your application is moving forward through the process. If you want to know the status of the application, you can log into MOHELA's website. And if you have full access, you want to look for PSLF in the horizontal navigation bar. And then from that drop-down menu, you should be able to see the payment tracker. If you go to the payment tracker, you'll be able to look month by month and see which months have been designated as eligible payments or eligible periods of repayment, and how many of those months have the employment verified to match them. So if you have not logged onto MOHELA's website and you applied for PSLF a while ago, you received that low count, I encourage you check in, see if there's been any progress made in your count. For some people, they're logging in and they're seeing a 0 balance, which is followed by the official letter that says, congratulations, you have met the requirements of public service loan forgiveness. But the payment tracker can give you an update in the interim. So to stay on track, to fully answer this borrower's question, the first thing is you want to make sure that you complete the PSLF application annually and if or when you change employers. For this particular borrower, they only need to fill that application out one more time if they remain with their current employer. That is when they reach the 120th month. So just make sure that if you are a bit earlier on this PSLF journey, it helps to complete that application annually so that your employment can be verified and your qualifying payment count will update each year. Next point is you have to remain working for a qualifying employer. It's public service loan forgiveness. So without the public service, there is no loan forgiveness. So if you change jobs, you want to make sure that you stay within the realm of public service, working for government agencies or 501c3 tax exempt organizations, and perhaps some other tax exempt organizations. Next, you want to make sure that you're enrolled in a qualifying repayment plan in order for your future payments to count. The income-driven repayment plans are the safest plans when it comes to qualifying for public service loan forgiveness, and they're also the ones that for most people will yield a balance left to forgive after you've been in repayment for 120 months. So you want to make sure that you're enrolled in a qualifying repayment plan so that you stay on track and those future payments will count. Finally, once you reach the 120th month, you want to submit the PSLF application. Submit that after you reach the 20th month so that your employment can be verified and the debt can go on to be discharged. If this is your first time applying for PSLF, you have never applied before, I strongly encourage you to complete the application by May 1st of 2023 to receive the greatest benefit. That date is important because that is the date that is included in the IDR adjustment, the income-driven repayment adjustment. It's giving the most lenient rules for what qualifies as or what counts as a qualifying payment. So get those applications in by May 1st of 2023 so that your application can be assessed under the more lenient rules. All right, let's move on to the next question. Next question is, I went to school in the 1990s. I've been in repayment for what feels like forever, and I don't work in public service. Is there help for me? So this question is about debt relief and specifically if there is any help for borrowers outside of public service loan forgiveness. And this is a very common question. Because this borrower has had their student loans since the 1990s, I really encourage them to look at the IDR adjustment, and they may receive cancellation without having to do anything else. But just to walk through some of the details of the IDR adjustment first, in spring of 2023, so coming up soon, borrowers with loans that have accumulated time in repayment of at least 20 or 25 years will begin to see automatic forgiveness, regardless of their enrollment in an IDR plan. So if you've been in repayment since the 90s, it depends on if it's the late 90s, but if you've been in repayment for more than 25 years, in theory, this IDR adjustment should result in the automatic cancellation of your debt. For others who are on the path but have not been in repayment for at least 20 or 25 years, starting in the summer of 2023, if you have direct or federally held FFEL loans, you should see your account updated with a payment count. The payment count is going to serve as kind of a progress indicator to let you know where the goal is, whether it's 20 or 25 years, and how close you are to that goal. Now, if you have commercially managed loans, these are loans that are not direct and not federally held. This could be FFELP loans, Perkins loans, health education assistance loans, or other non-direct loans. To benefit from the IDR adjustment, you need to apply for a direct consolidation loan by May 1st of 2023. That will give you the full benefits of this one-time account adjustment. So if you go to studentaid.gov and look at your loan types and you see that they are not direct loans and they are not federally held FFELP loans, then you would need to consolidate by May 1st to get the full benefits of the IDR adjustment. Also, if you're a borrower who is in default or you have some student loans that are in default, you can still benefit from the IDR adjustment, but you need to get out of default first. So please consider reaching out to the default resolution group. Do that as soon as possible so that those loans can be placed back into good standing and you can benefit from the IDR adjustment. And you want to make sure that you do that before July of 2023. Right. So about this IDR adjustment and why it's so beneficial to apply by May 1st of 2023 if you have to consolidate. The types of periods that are being counted toward IDR forgiveness include more than just months when you made a payment on time in full as promised. This list shows you what's included in counting as time toward IDR forgiveness. First is any months in which you had time in a repayment status, regardless of the payments made, the loan type, or the repayment plan. Next is 12 or more months of consecutive forbearance, or 36 or more months of cumulative forbearance. And this counts toward IDR and PSLF forgiveness. Also, any month spent in deferment prior to 2013, with the exception of in-school deferments. And finally, any time in repayment prior to consolidation on consolidated loans. So when you look at all of these items, this just makes obtaining forgiveness a lot easier. And these months will count both toward the IDR adjustment and PSLF by way of the IDR adjustment, as long as the borrower provides documentation of matching qualifying employment. The way to do that is submitting your PSLF application and submitting it by May 1st, 2023 to get the greatest benefit. You can submit your PSLF application online via studentaid.gov/PSLF to get on record by May 1st of 2023. The application does have to be verified by your employer or employers. So for each qualifying employer, they'll need to verify your employment, the dates, the number of hours worked on average, and your status as a full-time or part-time employee. So if you think you might qualify for PSLF, please do get that application in during the IDR adjustment. You can do your part at studentaid.gov/PSLF, have your employer verify the details and give that form back to you, and then send that form to MOHELA so that they can begin to count up your qualifying payments and let you know where you stand relative to the 120 payments needed for public service loan forgiveness. And since I already talked about PSLF, we're talking about the IDR adjustment, but because PSLF can work through the IDR adjustment, I just want to make sure that people don't rule themselves out for the quicker alternative. Public service loan forgiveness takes a minimum of 10 years or 120 months of the work and repayment history. IDR cancellation would take a minimum of 20 years. So if you have any employment, qualifying employment after October 1st of 2007, and you've had loans in repayment for that long, please do pull your employer's employer ID number and enter it at studentaid.gov/PSLF, where there's an option to search for qualifying employers, just to see if you have qualifying employment that may put you in the position to secure cancellation via PSLF. Now, for those of you who have not worked in public service, but are still longtime borrowers, if you borrowed and went into repayment in the mid-90s, then you should have more than 25 years in repayment. But the IDR adjustment could accelerate cancellation, especially if you have non-direct loans. So just sharing a few next steps. The first one is to verify your loan type. Are your loans direct or non-direct? You can find that out at studentaid.gov. If your loans are direct, then you do not need consolidation for them to be considered during the IDR adjustment. If you have FFELP loans and you're interested in PSLF through the IDR adjustment, you must consolidate those FFELP loans because FFELP loans don't qualify for PSLF. So if you have FFELP loans, you're interested in PSLF, you have to consolidate them to get them on track for that. But if your FFELP loans are federally held loans and you're not pursuing PSLF, you're just interested in the IDR adjustment, then you could leave those loans as FFELP loans, as long as they're federally held. However, if they're commercially held FFELP loans, you must complete the loan consolidation application, which is online at studentaid.gov by May 1st of 2023 to get the full benefits of the IDR adjustment. And again, those months credited toward the IDR adjustment can count toward PSLF as long as you verify your qualifying employment. And you'd want to get that application in by May 1st of 2023 to get the greatest benefit. The second step is to consider your repayment options. With IDR cancellation, it should happen after a maximum of 25 years in repayment. For some people, it's 20 years. If you have not been enrolled in an IDR plan so far, and you have not met the requirement of 20 or 25 years, you would need to be enrolled in an income-driven repayment plan so that your future payments would count toward that IDR cancellation. But for some people, when they look at the IDR plans, the repayment options are not favorable for them. It could be that their income is very high relative to what they owe. So switching to an income-driven repayment plan would mean that their payment is going to go up quite a bit, and they might not want to do that. They might decide that they just want to continue to pay off the loan and not pursue cancellation through IDR. If you are uncertain about this, I strongly encourage you to go to studentaid.gov, and on the loan repayment menu, you'll see something called the loan simulator. The loan simulator will allow you to estimate your income-driven repayment plan options so that you can see if it's feasible for you to switch from one of the fixed plans over to an IDR plan and therefore pursue forgiveness or cancellation through the IDR adjustment. So when you look at those IDR plans, you want to know, are they affordable? If the plans are affordable, you want to make sure that you enroll in an IDR plan for future payments so that those future payments count toward IDR cancellation. But really, none of us will know exactly where we stand. For those of us who have less than 25 or 20 years of repayment history, we're not going to know where we stand until we receive the payment count over the summer. For those of you that have been in repayment much longer, the decision really comes down to what type of loan you have and if the IDR options are affordable for you. So please take a look at the loan simulator, verify your loan types, and really think about whether it's feasible for you to get on track with an income-driven repayment plan and seek cancellation after that 20 or 25-year period. It's a very personal decision. Lots of factors influence whether it's feasible or preferable. So make sure that you take into account your loans, the balances, the types, the repayment options before you consolidate and attempt to pursue cancellation via IDR. I have to mention PSLF just one more time because this IDR adjustment is providing an opportunity for people to benefit from the more lenient rules when they're applying for public service loan forgiveness. So the slide you see here is loan forgiveness via PSLF in 4 steps. This is specifically during the IDR adjustment period. The first step is to confirm your employer's eligibility by using the PSLF help tool. If you visit studentaid.gov/PSLF, you'll see a button there to search for qualifying employers. Gather all the employer ID numbers for the employers you worked at after October 1st of 2007. And knowing that the only periods that count will be periods when you have loans that were in repayment. But get all of those EINs together and you can use the search feature to determine if those employers indeed qualify for public service loan forgiveness. The second step is to view your loan types via studentaid.gov. If you have FFELP loans and you're pursuing PSLF, you have to consolidate them because they will not become eligible for PSLF until they are consolidated into the direct loan program. If your loans are already direct and they were all borrowed around the same time, and you don't have gaps in the repayment history between borrowing, then you don't need to consolidate, and you can move on with submitting your PSLF application, which leads to step 3. If necessary, consolidate your loans online via studentaid.gov. The application is there on the loan repayment menu. It's something you can do online yourself and for free. The final step is to verify your employment by completing the PSLF application via studentaid.gov/PSLF. So after you got the EINs, after you figured out your loan types and whether you need to consolidate, submit your PSLF application by May 1st of 2023. The online portion of the application you can complete pretty quickly. You'll need to send the page that requires an employer signature to each employer. They should send it back to you, and you can forward that to MOHELA so that MOHELA can begin the transfer process if necessary, and then begin tallying up your repayment history and your employment history to see where you stand relative to that 120. Quick note about the employers. Some employers will actually send in the PSLF application for you. That's a part of their process. I personally would like to get my application back so that I can send it and I can know that it's sent. If your employer sends like a fax confirmation, that would be lovely after they've sent the application into the servicer. But my personal preference is to get all of my employment verified, get the forms back from the employer, and then submit everything to MOHELA so that I would be in control of the documents and know that they have been sent. But please, if you're in this process, get your applications in by May 1st of 2023. So that does it for me. Those are all the questions that came in from the community since our last edition of Office Hours. I'm going to take a pause and go to our Facebook Live and see if there are any questions there. I don't see any there. And I will check the chat just one last time. I don't see anything in Q&A. All right. So thank you so much for joining me for this edition of Office Hours. If you have any questions that come up after the broadcast, please do feel free to drop a comment on the Facebook video. Reach out via the contact form on our website at mccfw.org. And we will be in touch with you. You can also connect with us on social media at the MCCFW.